Foremost means more. More training, more information, more ways to grow your business. Find out what Foremost can mean for you at foremostagent.com. Click on Foremost Means More.
Readers of Aon Benfield's Reinsurance Market Outlook Report, published in January, came across an eye-popping figure attached to total capital for the reinsurance market. In this interview with Carrier Management Susanne Sclafane, Bryon Ehrhart, chairman of Aon Benfield Analytics, explains how the $500 billion number was derived.
Yeah, thanks for asking that question. We get this one often. So the $500 billion is capital that we count in every aspect that's devoted to taking catastrophe risk for insurance companies. So we do count all of the capital in platforms where you have, in many cases in the industry, a carrier that writes both insurance and reinsurance. And we do count all the capital, not just the part that's devoted to reinsurance, because oftentimes they don't disclose how much capital is involved in the reinsurance business. But we all know that at the top of that organization there's a CEO and a board that's figuring out, well, how much capital do we devote to reinsurance versus insurance, and if reinsurance looked better, they'd allocate more capital to reinsurance. So we count all of that, and that might be somewhat of an overstatement of how much capital is in the reinsurance business. But then if you said, what are we really trying to do? We're trying to look at what the price and capacity implications are to our client. And knowing that they kind of make those kind of allocation differences, you then look inside of client placements and say, well, how many of our clients place reinsurance with people who only do reinsurance? All clients do play some of it, but it might be 30 or 40% of the program. So the remainder is placed with these multi-lines. We also count government funds that provide reinsurance or reinsurance-like capital. And with the state of many sovereign nations and individual states in the United States that are participating in this, the amount of capital they're willing to deploy, like the FHCF is a good example. The amount of capacity they're willing to deploy after 2006, they decided to deploy $16 billion more. That had an effect of really negating the need for a lot of the reinsurance capacity that was raised by new companies in the 2005 class. So a lot of the 2005 class opportunity was reduced. Their opportunity was reduced by the fact the FHCF, through legislation, increased capacity by $16 billion. We think it has an impact. And remember, our goal is to project capacity and price. So these things you have to count, or you're not going to be able to project capacity and price. So there are other things like the JER in Japan that took the vast majority of the homeowners or residential losses in Japan from the tsunami and earthquake. If that didn't exist, the price of reinsurance in Japan would be dramatically different. So those kinds of things, if we're trying to project capacity and price, you have to count all of the aspects of capital that influence capacity and price. So that's how we come to the number. It is not something we've changed. We have been doing it consistently for 7 or 8 years.
In addition to record capital, cat bond activity reached levels as well in 2012.
We've reached a new peak. I think it's $16.5 billion of outstanding CUSIP and rated cat bonds. So we're excited to reach a new peak. It was exciting to reach the last peak, and that was 2006. That peak was built with it was pre-crisis, built with a lot more hedge fund interest, levered hedge funds. This peak has been rebuilt in a much more I think reliable way for clients. Not saying that hedge funds and others that were interested in 2006 weren't reliable. They were reliable. They bought the bonds, and those bonds didn't go away. They continued to serve the client's interest that was originally involved in the sponsorship of the transaction. This peak, though, is built with a lot more life insurers, pension funds, endowments, and high net worth individuals involved in the business. And as an example of the stability of that source of capital is, the secondary trading of these securities has dropped, because the people that are buying them are holding them. They are going to hold them very likely to maturity. So it's a market that says we like the asset class and we like it long term. We're devoting monies that are buying and holding. So it's a different peak this time. We're excited about this peak. It seems much more normal to reflect to a client the kinds of people that are buying these bonds and why they're interested. The story hangs together a lot better than hedge funds that are trading them on leverage.